Something changed around XRP this week, and most people still don't understand how important it actually is. On the surface, it looked like just another political headline, another committee vote, another boring government process buried under layers of bureaucracy that most people immediately ignore. But beneath that vote, something much bigger quietly moved into position.
And that's a completely different conversation than the average retail crypto cycle. For years, XRP critics argued that regulation would destroy crypto adoption. But Ripple made a completely different bet. Instead of fighting institutions, they leaned into them. While much of crypto positioned itself as anti-bank, anti-government, anti-system, Ripple spent years building relationships with financial institutions, licensing, compliance, payment infrastructure, cross-border settlement systems, liquidity partnerships, and at the time, many people mocked that strategy because during the early crypto years, decentralization narratives dominated everything. Banks were considered the enemy. Traditional finance was supposedly dying. But what if the future never looked like financial destruction? What if the future looked like integration instead? That possibility suddenly changes how people view XRP entirely, especially now that governments appear far more interested in regulating crypto than eliminating it. And once regulation enters the picture, utility suddenly matters a lot more than hype. That's where Ripple's positioning becomes incredibly interesting. Because utility-driven infrastructure tends to survive regulatory environments far better than speculation-only projects. And now, even some of the biggest names connected to Ripple are openly suggesting the industry may be much earlier than people think. During a recent discussion, David Schwartz compared the current crypto industry to the internet around 1998 to 2000. That comparison is far more important than it first appears, because most people only remember the winners that came after the internet boom. They forget how uncertain the late 90s actually felt. At the time, infrastructure was incomplete, adoption was fragmented, governments were confused, businesses were skeptical.
Fast. That's the part many retail investors still fail to understand. Markets are not driven purely by technology. They are not driven purely by hype, and they are definitely not driven purely by social media narratives. Markets move when institutions finally believe the rules of the game are becoming clear. And this week, something happened in Washington that may have just opened the door to the next phase of crypto itself. Not just meme speculation, not just retail gambling, not just another temporary altcoin cycle, but something far larger, something infrastructure level. Because while most people were distracted watching price candles move sideways, some of the largest XRP wallets in existence were quietly accumulating again, aggressively. And when you combine that whale activity with what just happened politically inside the United States Senate Banking Committee, the picture starts becoming extremely difficult to ignore, especially when people connected to Ripple are now openly talking about institutional adoption as if it's no longer a distant theory, but an approaching reality. That's when this story stops feeling like normal crypto speculation and starts feeling like preparation. Because the strange part isn't that XRP supporters remain bullish. The strange part is, who else suddenly seems to be positioning themselves, quietly, carefully, almost like they know something is changing behind the scenes. Earlier this week, the United States Senate Banking Committee pushed forward a major cryptocurrency clarity bill in a bipartisan vote. Now, for most people, that headline means absolutely nothing. But inside financial markets, bipartisan support changes everything. Because politics in America has become so divided that getting both sides to cooperate on anything meaningful is extremely rare. And yet somehow, crypto regulation is now becoming one of the few areas where resistance appears to be weakening. That matters more than people realize. Because for years, one of the biggest problems facing crypto wasn't technology, it was uncertainty. Institutions didn't know which assets would be classified as securities, what regulations would look like, how compliance frameworks would operate, or whether governments would ultimately support or suppress the industry. And institutions hate uncertainty. Retail investors chase volatility. Institutions avoid unclear environments entirely. That's why so much money stayed on the sidelines. But now the environment is starting to shift, slowly. Then suddenly, the vote that just passed inside the Senate Banking Committee was not the final step. The legislation still needs broader Senate approval, but that's not actually the most important part. The important part is psychological, because markets move before events fully happen, not after. And once investors begin believing clarity is inevitable, positioning starts immediately. That's exactly what may already be happening right now with XRP. Because while media attention remains relatively muted, on-chain data has been telling a completely different story. Large XRP holders have been accumulating during weakness. Not selling, accumulating. Massive amounts of XRP have reportedly been moving off exchanges and into long-term wallets. That distinction matters enormously. When assets leave exchanges, it usually signals reduced intent to sell. And historically, periods of aggressive exchange outflows often appear before major price movements. Now, does that guarantee XRP explodes tomorrow? No. But it does tell you something important about confidence levels among large holders. Because whales do not accumulate during fear unless they believe something larger is developing. And what's fascinating is how perfectly this accumulation phase aligns with the changing political landscape surrounding crypto regulation in the United States. Almost like two separate worlds are beginning to converge at the exact same time. One political, one financial, one regulatory, one institutional. And XRP seems to be sitting directly in the middle of both. That's where this story becomes much bigger than price speculation. Because what's happening around Ripple increasingly feels connected to the future structure of financial infrastructure itself. And that's a completely different conversation than the average retail crypto cycle. For years, XRP critics argued that regulation would destroy crypto adoption. But Ripple made a completely different bet. Instead of fighting institutions, they leaned into them. While much of crypto positioned itself as anti-bank, anti-government, anti-system, Ripple spent years building relationships with financial institutions, licensing, compliance, payment infrastructure, cross-border settlement systems, liquidity partnerships. And at the time, many people mocked that strategy because during the early crypto years, decentralization narratives dominated everything. Banks were considered the enemy. Traditional finance was supposedly dying. But what if the future never looked like financial destruction? What if the future looked like integration instead? That possibility suddenly changes how people view XRP entirely, especially now that governments appear far more interested in regulating crypto than eliminating it. And once regulation enters the picture, utility suddenly matters a lot more than hype. That's where Ripple's positioning becomes incredibly interesting. Because utility-driven infrastructure tends to survive regulatory environments far better than speculation-only projects. And now, even some of the biggest names connected to Ripple are openly suggesting the industry may be much earlier than people think. During a recent discussion, David Schwartz compared the current crypto industry to the internet around 1998 to 2000. That comparison is far more important than it first appears, because most people only remember the winners that came after the internet boom. They forget how uncertain the late 90s actually felt. At the time, infrastructure was incomplete. Adoption was fragmented, governments were confused, businesses were skeptical, and most people still didn't understand what the internet would become. But beneath that uncertainty, the foundation of an entirely new system was already being built, quietly. And according to Schwartz, crypto may currently be entering a very similar phase. Not the end, not maturity, the beginning of institutional scale integration. That changes the timeline dramatically, because if crypto is truly in its 1998 internet phase, then the biggest moves may still be ahead, not behind. And suddenly, Ripple's long-term focus on regulation and institutions starts looking far less random. It starts looking strategic, especially when you look at how macro conditions are evolving globally. Governments everywhere are now discussing digital payment systems, CBDCs, stablecoin regulation, tokenized assets, cross-border settlement modernization, and real-time liquidity infrastructure. These conversations barely existed at scale a few years ago. Now they're happening everywhere. And that's why some investors believe XRP is no longer just trading as a cryptocurrency. They believe it's trading as a potential piece of future financial infrastructure. That distinction changes investor psychology entirely. Because speculative assets rise and fall with hype, infrastructure assets rise with adoption. And the market may slowly be starting to recognize the difference, especially after years of delay, years of lawsuits, years of uncertainty, years of political resistance. Now suddenly, legislation is advancing, institutional narratives are strengthening, whales are accumulating. And Ripple executives sound increasingly confident about where adoption is headed. That combination is not normal, and it's creating a level of tension around XRP that feels very different from previous cycles. Because this no longer feels like people chasing quick profits. It feels like positioning before a system transition. And the deeper you look into what's quietly unfolding around regulation, banking infrastructure, liquidity systems, and institutional crypto adoption, the harder it becomes to dismiss what Ripple may have been preparing for all along. The market is beginning to realize something uncomfortable. If cryptocurrency regulation in the United States finally becomes clear, then the entire conversation around XRP changes overnight. Because for years, XRP existed inside a cloud of uncertainty that scared away major institutional participation, not because institutions hated the technology, but because institutions cannot operate in gray areas. A hedge fund can speculate in uncertainty. A bank cannot build infrastructure on it. That distinction became one of the biggest hidden barriers holding XRP back during the last several years. And ironically, the SEC lawsuit may have delayed adoption while simultaneously preparing XRP for a much larger role later. Because while much of crypto spent years chasing narratives, hype cycles, and meme-driven speculation, Ripple was forced into survival mode. And survival mode changed everything. The company had to become legally resilient, politically aware, globally connected, and institutionally credible. Most crypto projects never went through that pressure test. Ripple did, publicly, painfully, for years. And now suddenly, the environment that once looked hostile toward XRP is beginning to flip. That's what makes this moment feel so strange. Because the same regulatory system that once threatened Ripple may ultimately become the reason institutions finally feel safe entering the market. And if that happens, XRP's positioning starts looking radically different from how retail investors traditionally viewed it. Because this next phase may not be driven by retail at all. That possibility changes the psychology of the entire market. You can already see hints of it developing beneath the surface. For months, crypto enthusiasm started fading. Momentum slowed. Liquidity weakened. Investors became impatient. Many expected immediate pro-crypto policies after the political transition in the United States, but instead, attention shifted toward tariffs, geopolitical tensions, inflation concerns, and broader macroeconomic instability. And during that period, something dangerous started happening psychologically. People began doubting the thesis. Not just for XRP, for crypto itself. The excitement that dominated late 2024 started cooling down. Retail traders became exhausted. Markets moved sideways. Sentiment deteriorated. And historically, those are the exact moments when smart money quietly accumulates. Not when retail becomes euphoric. When retail becomes emotionally drained. That's the phase where conviction gets tested. Because emotionally, sideways markets feel worse than crashes. Crashes create panic. Sideways markets create doubt. And doubt is what slowly pushes weak hands out of positions. That's why the recent whale behavior surrounding XRP matters so much. Because while retail frustration increased, large holders reportedly continued stacking aggressively. Not cautiously, aggressively. Wallets holding massive quantities of XRP reportedly climbed even during periods of weakness. Now ask yourself an important question. Why would sophisticated holders increase exposure during maximum uncertainty? Especially after years of legal pressure, delayed adoption, and market stagnation, there are only a few possibilities. Either they are catastrophically wrong, or they believe the market still does not fully understand where this is heading. And when you connect that behavior to the timing of advancing crypto legislation, the pattern becomes difficult to ignore. Because institutions do not wait for headlines. They prepare before headlines. That's how capital survives. And XRP increasingly looks like an asset sitting directly at the intersection of regulation, liquidity infrastructure, banking integration, and institutional digital asset adoption. That's a very different positioning than speculative meme cycles. It's also why the comments from David Schwartz recently carried so much weight inside the XRP community. Because when someone deeply connected to Ripple starts comparing modern crypto adoption to the internet boom era, experienced investors immediately understand the implication. The implication is scale, massive scale. Not overnight, but gradually, then suddenly. That's how transformational systems emerge. The internet did not dominate society in 1 year. First came infrastructure, then regulation, then adoption frameworks, then enterprise integration, then mass consumer behavior changed. Crypto may now be entering that same transition phase. And if that's true, then current market valuations across the sector may still represent extremely early positioning, especially for projects aligned with regulation instead of fighting against it. That's the hidden shift happening beneath the surface right now. The market is slowly transitioning away from pure anti-establishment narratives and toward compliant integration narratives. That doesn't mean decentralization disappears. It means governments and institutions are no longer ignoring digital assets. They're preparing frameworks around them. And when governments begin building frameworks, infrastructure players suddenly become far more valuable. That's why Ripple's long-term strategy now appears incredibly important. Because years ago, many crypto communities believed banks would simply disappear. But that never happened. Instead, traditional finance adapted, quietly. And now many major institutions appear to be exploring tokenization, stablecoins, blockchain settlement systems, and real-time liquidity infrastructure all at the same time. That's not coincidence. That's transition. and transitions create enormous winners. But only a handful of projects are positioned correctly when those transitions happen. That's where XRP believers think the market still misunderstands Ripple entirely. Because from their perspective, Ripple was never trying to replace the financial system. They were trying to modernize parts of it. That distinction is massive, especially politically. Governments are far more likely to support modernization than destruction. And once regulatory clarity enters the equation, the floodgates for institutional participation potentially begin opening much wider. That's why the recent Senate developments feel bigger than most people realize. Not because one committee vote instantly changes everything, but because perception is changing. Momentum is changing. Probability is changing. Even prediction markets reportedly surged dramatically regarding the chances of crypto clarity legislation passing after the bipartisan committee advancement. And prediction markets matter because they often reflect informed positioning before mainstream narratives fully catch up. People close to policy movements, capital flows, and institutional expectations often position early. Retail reacts later. That's why moments like this become so important psychologically. Because suddenly, the future scenario XRP supporters envisioned for years no longer feels impossible. It starts feeling plausible, and plausibility changes behavior. The moment institutions believe regulatory clarity is inevitable, they begin preparing operationally, not emotionally, operationally. That means custody systems, compliance frameworks, liquidity partnerships, tokenization infrastructure, cross-border payment systems, banking integrations, and enterprise-level settlement architecture. These things require years of preparation, not weeks. And that's exactly why many XRP supporters believe Ripple spent years building quietly while the broader market focused on hype cycles. The infrastructure phase is boring, until suddenly it isn't. Until suddenly the market wakes up and realizes the pipes underneath the financial system were already being installed. That realization creates explosive repricing events, not because hype suddenly appears, but because the market suddenly understands utility differently. And utility narratives become extremely powerful once regulation legitimizes the industry. That's why this moment around XRP feels uniquely tense right now. Because if the clarity legislation ultimately succeeds, and if institutional adoption accelerates, and if Ripple's positioning around compliant infrastructure proves correct, then the market may eventually look back at this entire period very differently, not as the end of XRP's story, but as the quiet accumulation phase before institutional scale adoption truly began. And the unsettling part for many investors is this. Some of the biggest players in the market may already be positioning as if that future is coming. What makes this entire situation so fascinating is that XRP's story no longer looks isolated. It's beginning to connect with something much larger happening across the global financial system itself. And once you start seeing those connections, it becomes very difficult to unsee them. Because while most retail investors focus only on price charts, governments and institutions are focused on something completely different: the future movement of money. Not memes, not social media trends, infrastructure, efficiency, liquidity, settlement speed, cross-border interoperability. Those are the conversations quietly happening behind closed doors right now. And for years, those conversations barely involved crypto at all. But suddenly, they do. That's the hidden shift most people still haven't fully processed. The financial world is no longer debating whether blockchain technology matters. That debate is over. Now the discussion is becoming: which systems survive, which assets integrate, which networks institutions can actually trust. And trust inside institutional finance is built through three things: regulation, reliability, and liquidity. That's precisely why Ripple's positioning has started attracting attention again. Because while speculative crypto projects were built around community excitement, Ripple spent years trying to solve institutional problems: cross-border settlement delays, liquidity inefficiencies, Nostra and Vostra account capital traps, payment fragmentation, slow international transfers. These are trillion-dollar inefficiencies hidden inside the current financial system. Most people never think about them because consumers only see the surface layer of finance. They don't see the machinery underneath. But institutions do. Banks do. Governments do. And if blockchain technology is eventually integrated into the global financial infrastructure stack, the winners may not necessarily be the loudest projects. They may be the projects already aligned with institutional requirements. That possibility completely changes how XRP is viewed, because suddenly XRP stops looking like just another crypto asset competing for hype cycles. It starts looking like a potential bridge asset within a much larger liquidity ecosystem. That's why the timing of regulatory clarity matters so much. Without clarity, institutions hesitate. With clarity, operational deployment becomes possible. And this is where things get psychologically interesting. because retail investors often think institutional adoption will arrive dramatically, like some giant announcement where banks suddenly reveal everything overnight. But real institutional adoption almost never works that way. It happens quietly first. Pilot programs, testing environments, liquidity corridors, partnership expansions, regulatory alignment, small deployments, then gradual scaling. That's how infrastructure transitions happen historically, slowly at first, then suddenly everywhere, exactly like the internet. And that's why David Schwartz's comparison carried so much weight. Because if crypto truly resembles the internet around the late 1990s, then the market may still be massively underestimating the scale of eventual adoption. Back then, most people saw websites as novelty projects. Very few understood the internet would eventually become commerce, communication, entertainment, banking, media, logistics, and global infrastructure itself. The biggest transformations always look smaller before they happen. That's the pattern. And XRP supporters increasingly believe digital asset infrastructure may now be approaching a similar inflection point, especially because the macroeconomic environment is forcing financial modernization faster than many expected. Around the world, governments are facing pressure from rising debt, slower settlement systems, currency competition, liquidity fragmentation, and increasing demand for real-time financial infrastructure. Meanwhile, tokenization discussions are accelerating. Stablecoins are expanding. CBDC experiments continue globally. Financial institutions are exploring blockchain settlement more seriously than ever before. These are not isolated trends. They are connected. And when multiple global systems start evolving simultaneously, markets begin repricing entire sectors. That's why some XRP investors no longer see Ripple as merely a crypto company. They see it as a financial infrastructure company positioned inside the digital transition era. And whether critics agree or not, the regulatory environment is now beginning to move closer toward that possibility. That's what makes the recent Senate Banking Committee advancement so psychologically important. Because the signal being sent to markets is bigger than one bill. The signal is this: the United States may finally be preparing to stop treating crypto as regulatory chaos. And if America fully embraces structured digital asset regulation, enormous institutional capital could eventually enter the space much more aggressively, not recklessly, strategically. That distinction matters. Institutional money does not chase narratives emotionally. It waits for legal frameworks, operational clarity, compliance certainty, risk reduction. And once those conditions begin forming, positioning starts before retail fully notices. That's why whale behavior becomes so important during uncertain periods. Because large holders often move based on long-term structural expectations rather than short-term emotional sentiment. And XRP whales have been behaving unusually confidently despite months of broader market frustration. That doesn't automatically guarantee success, but it absolutely suggests conviction, strong conviction, especially considering the scale of some of these wallets. Because here's the uncomfortable reality most retail investors ignore. Large capital allocators rarely spend years studying assets they believe have no future relevance. And XRP has remained one of the most heavily discussed institutional-facing digital assets despite years of controversy. That alone is interesting. But what becomes even more fascinating is how the emotional narrative around XRP keeps evolving. Years ago, XRP optimism was driven mostly by retail speculation. Today, the narrative feels much more infrastructure-focused, much more regulation-focused, much more institution-focused. And those shifts matter because narratives determine capital flows. If the market begins viewing XRP less as speculative crypto and more as financial infrastructure, valuation psychology changes dramatically. Infrastructure assets are valued differently than speculative assets. Infrastructure attracts long-term capital. Infrastructure attracts partnerships. Infrastructure attracts governments. And infrastructure becomes extremely valuable once adoption reaches critical scale. That's why the next phase of crypto may look very different from previous cycles. The previous era was dominated by hype, decentralization maximalism, speculative mania, and rapid retail inflows. The next era may be dominated by compliance, tokenization, banking integration, liquidity systems, and enterprise adoption. That's exactly the direction David Schwartz hinted toward when discussing institutional adoption potentially arriving within the next few years. And if he's right, then the market may still be dramatically underestimating how much infrastructure is currently being built behind the scenes. Because the most important financial transitions rarely happen loudly. They happen quietly, until suddenly the new system is already operational. And by the time the public fully notices, the biggest positioning opportunities are already gone. That possibility is exactly why XRP continues creating such emotional intensity among investors. Because if Ripple truly positioned itself correctly for the coming regulatory era, then this entire period of uncertainty may eventually be remembered very differently. Not as failure, not as stagnation, but as the calm before institutional scale acceleration finally arrived.